Well, welcome and thank you all so much for coming to attend today's webinar. I am your host, Missy Liu, and we'll also have Chris Nelson from Runaway Capital. I'm the founder and manager of Life Mission Capital. Today, we'll talk about mobile home parks, one of the asset class I've been monitoring for a little bit over a year now. And I recently toured some assets in that space as well for our acquisitions. So I'm really excited to share with you why we have been really thinking and also are going into this asset class because it is one of the most recession resistant asset class. Now, Chris, can you hear us? Are you able to speak?
Yes, I am able to speak. I am here. Thank you so much, Missy.
Awesome, Chris. So in this presentation, we're going to cover a few things. Just a quick intro about my company and the economics market update and what mobile home parks now and how we can make an impact and profit with us at Life Mission Capital before we move on to the Q&A section. If you have any questions throughout, feel free to put in the Q&A section as well. So disclaimer, everything is for general purpose only, that it's not any tax, accounting, or legal advice at all. And I want to congratulate for being here because even though we're talking about mobile home parks, really it is about freedom and the legacy you want to create. So congratulations for being here. And it's only financial freedom is only for those who not only learn about it, but work for it as well. As you know, you can only have 1 or 2 jobs, but you can have as many mobile home parks as you can. So about me, I am a general partner and fund manager through my company called Life Mission Capital. We're a little bit over 1,000 units in terms of asset under management. And I started also in another investment club with a little bit over 700 members as well. I'm originally from China. You can probably tell the little accent I have. And I came here when I was 16 years old and love this country. That's why I've stayed here for the past 12, 13 years. And in terms of my background, apart from the real estate side, I actually have a strong analytics background, and Chris can attest to it as well when we're going through the due diligence process together. I ask a lot of questions on numbers, and I'm proud to say that I use that skill set to really help myself, my family, and also my investors to passively invest into that space. So I started my journey accidentally in 2019 by house hacking. Once I got a taste of passive income, I was like, wow, the stock market just no longer satisfies me. And I just loved how real estate really add up being a numbers person. So now I not only passively invest into real estate, different types of real estate from multifamily to short-term rentals, now going to mobile home parks and also build to rent as well. But I also help others passively invest. So if you don't know the benefits of passive investing, feel free to, contact me afterwards, but it's really a lot limited risks as a passive investor, but you get also hard benefits typically and profit than investing yourself in single family space. And you get to diversify from or include real estate into your portfolio. So now, Chris, would you like to give an intro about yourself as well?
Yeah, so thank you so much, Missy. My name is Christopher Nelson, and I am the managing principal of Runaway Capital. And so I got into real estate coming from a tech background as well, having gone through some IPOs. I realized I was very overexposed in the stock market and wanted to be in a position again where I had something that was providing me checks. So that was my journey into real estate. Since then, founded Runaway Capital that we invest in multifamily. We've also invested in ATMs, automated teller machines, and now mobile home parks. And again, find phenomenal partnerships with people like Missy and Life Mission Capital so that we can, help other tech professionals and professionals themselves figure out how to become financially independent. Back over to you, Missy.
Thank you, Chris. Yeah, and one of the reasons I've been able to really explore in the space and I'll talk to different operators as well. But we ended up wanting to work with Chris and his partners in this space. So why mobile home parks, right? We'll talk about the recession resistant part, but let's just take a recap of what's happening in the market. S&P is about more than 20% down. Inflation is 8% and more. Bonds even went down more than 13%. And I took a snapshot today, about our GDPs and etc. And Market Watch says the U.S. economy shrank in the first half of 2022. Updated GDP confirms. It's no news to most of us, I assume. But sensing that we're already in a recession, most of us probably have to admit that just based on the GDP numbers. And let's take a look at what recession was like. We had about 11 recessions since 1950s. I excluded the Great Depression because they were a little bit extreme, and hopefully we don't have to get to that stage, and hopefully we don't have to worry about the war either. But generally speaking, the 11 recessions, they averaged about 10.2 months, and the shortest was in 2020, which is fairly recent, with 3 months, and the longest was 2007, which a lot of us are familiar with as well, 18 months. And the average time between recessions about 5 years and 6 months. Excluding the COVID blip, we'll have about 12 years since the last recession. So we're due for one. Even if you think we're not in one, it's coming. So how do we, as busy professionals or family breadwinners, whatever that might be for you, diversify into non-correlated assets that's more recession resistant? So not all of your funds are really just in the stock market going up and down, and watching it makes me feel a little crazy. And luckily most of my assets are in real estate these days. So let's take a look at this chart. I love data. I'm a data person. Net operating income in commercial real estate. If a lot of your investors, you would understand commercial real estate, the value of an asset is really depending on your net operating income plus the cap rate. Times divided by the cap rate. But the net operating income is such a major component, which is your gross income minus your expenses. So look at this chart here. During the 2009-2020 recession, almost all the other commercial real estate, took a dip, depending on what type of asset it is. But the mobile home parks, it just went up. You may or may not believe, why is that really possible? Like mobile home parks, sometimes people have the stigma thinking, oh, those type of assets, I don't know. But let's just look at the numbers. Let's dive into some of the reasons. And also looking at some of the projections as well, right? Moving forward, mobile home parks compared to the other potential commercial real estates, it's really ahead in its projections in terms of its growth as well. And that growth is really dependent on 5 factors. In anything in economics and business, it's really about supply and demand. But if we dive a little bit further into it, it's really 5 factors. So on the demand side, we'll look at the demand for affordable housing. Mobile home parks tend to be way cheaper than multifamily, even the Class C multifamily. So why is it affordable? Like, one of the things I mentioned about in the post that attracted most of you to come to the webinar today is about the housing shortage. We'll have about 5 million housing shortages around the US, right? Like a lot of people who were building homes in 2009 after that crash, they just simply didn't go back to it. So homes are in shortage, but affordable housing is even further shortage. About 20 million Americans, like it's 1/18, live in mobile home parks. Right, baby boomers, they retire with very little savings, living on Social Security, and we'll dive a little bit more into that. They also can't afford a lot of the luxury homes or even Class C homes. And from a supply side, it's really limited supply as well. And 10 new mobile home parks being built in the United States in a typical year, right? That's very low. And we'll dive into a little bit on the reasons why. And from a mobile home park owner standpoint, we also have tenants. And the tenants typically own their homes. Not always, but typically own their homes. And tenants tend to stay longer as well. And from a mobile home park owner investor standpoint, if we're just increasing the lot rent versus increasing like the entire home rent, right? That's a lot more reasonable as well. So they're more likely to stay because of that as well. In case you don't know, it's also a very fragmented market. You don't see institutional investors step into the mobile home park space because it's so fragmented. They don't quite understand the space. That means it's great for us to work with operators who can provide institutional quality in terms of its management and its operations. And for us to operate and also work with people that we like and trust, that be able to make an impact in those communities as well. And also from a cash flow standpoint, right? Because mobile home parks, and you'll learn a little bit as well, the expense ratio is a little bit lower. So it will tend to cash flow a lot higher. And it's not unusual to generate 10% plus in cash on cash returns. And the multifamily, that's, like could be double the typical cash on cash return multifamily compared to single family. Unless you're doing heavy renovations, you may not even cash flow in current market with still high prices and high interest rate. So let's dive into some of the points I mentioned a little bit more about the demand. So, right. So we'll talk about like, who are the people that typically like to live in mobile home parks, right? Like, I'm not familiar with the asset class until recently, and the past couple of months, me touring some of the assets and really understand who lives there. It's just normal people that tend to make lower income, and they need places to stay. And a lot of them are baby boomers. Like one of the tenants I ran into, she had like 8 granddaughters living with her, and they need affordable housing, right? So a lot of those people need affordable housing, and especially baby boomers. It's a large population, right? We look at some of the stats here. 28% of baby boomers, 45% of baby boomers have zero saved, and 28% have less than 100,000. I mean, how do they retire, right? So they really need affordable housing, and that's really in shortage across the nation, especially in some of the metro areas that we're going into. So, and they're not building more either. And the main reasons is, if you're purchasing a single family home, would you want your single family home to be next to a mobile home park? No, right? Like that people tend to reduce the value. People don't like that. So people don't like it. And also municipalities don't want to build much of it either. And when the builders do build something, then to prioritize single family homes, multifamilies, and not really prioritizing mobile home parks. That's why we talked about such little building activities in this area. As you can see, compared to the other asset classes, this is really in shortage here. So combined with the artificially constrained supply and a strong increase in demand, this is where we can reasonably rely on property values to increase over time on top of our value add plan to go in there, clean up the community, and help improve the community with all the operations we're putting as well. So what does impact and profit look like with us? Essentially, we take a look at areas that really need affordable housing in the first place, right? This is a map, like you can kind of tell where renters pay more than 30% of the income for housing. You can see kind of some of the darker areas. And that some of the areas that we're focused on is like North Carolina, Fayetteville area, and some of the areas in Alabama. You can see that affordable housing is really, really in need. And we tend to focus on areas that's roughly 500,000 or more in population, and they have high population growth. So they're continuing to look for affordable housing. And we want to stay at where, apartment rent for 2 bedrooms around 800 plus. So we can go in there with lot rent that's maybe $400, $500, $600. So one of the area I mentioned is Fayetteville, North Carolina. This is a good example of how we can grow with the community in this process. So typically, if you rent a 2 bedroom, and I did go into about 10 mobile home parks in Fayetteville, North Carolina. So I actually looked at some of the listings on apartments.com, 900, right now it's probably more like 1,000 in those areas plus. Whereas on lot rent, right, we can charge 400. That's a lot more affordable in some cases right now, because a lot of the mom and pop operators, they haven't been raising their rents, so it's even lower that we can bring up to the market. So that's really where we can grow with the community by cleaning up some of those areas as well. And not every mobile home park is like in the bad area. In fact, a lot of the mobile home parks we're going into, when I drove around, there's a lot of good business going on. And I would say they're more like B minus and C plus areas as well. So our general business plan in this process is to acquire and stabilize the property and then optimize the operations, whether it's, maybe electronic payments or maybe having better management throughout, better renovations. And then in year 5 to year 7, our plan is to return the capital so that investors can continue to deploy that capital velocity of money, continue to invest in more assets, whether it's mobile home parks or something else that they find, to generate the returns they need for their lifestyle, their freedom goals, and their legacy. And our plan is to continue to cash flow and hold, because we want to continue to build relationships and continue to grow with those communities and with our investors in the process. And typically our debt structure is a little different from the multifamily space, because banks don't tend to lend to the mobile home parks as much. So we tend to, if we do lend from banks, it tend to be more of the regional banks. And also we like to use owner financing as well, which, you know, during the Q&A session that Chris can also touch on a little bit more, as he works a lot more closely with those lenders as well. From an operational standpoint, it's really less expensive than multifamily, because we're not just renting the homes. Most importantly, we're renting the lot. And even if we're owning the home, our goal is really to have the tenant, the resident, own the home, because the homes is not as expensive. We can put them on a payment plan and let them own it. On one side, it's less expensive for us to maintain. On the other side, once they bought on it, you know, typically it's not that expensive, $5,000-$10,000, relatively speaking. And they can eliminate another bill from their overall day-to-day expenses. And in terms from Life Mission Capital standpoint, you know, we always have a thorough due diligence process. We have a 30-point checklist, but mostly evolves around experienced operators having great returns for our investors, and we're also building community as well. I mentioned a little bit earlier, I visited, you know, about 10 of these properties in Fayetteville, North Carolina. And I was really impressed with the work that Chris and his partners have been doing in those spaces. I talked to this lady, I mentioned to you guys a little bit earlier that she had like 8 or 10 girls living with her granddaughters. And she said she was feeling really safe about living there. And I was really happy to hear that. And I was asking her how she liked it. She said she felt really safe and it was affordable. And you know, other parks in the town may not have been so. So I think, you know, doing good business while you're able to provide safe, clean, and affordable housing is very important for us. And I hope that's important for our investors, whoever decide to work with us. Our opportunity is going to launch in October, which is fairly soon. In October, we're working through some of the legal paperwork. So if there's something you're interested in, please let me know. I will send you in the chat here my Calendly if you're interested in chatting a little more about passive investing strategies in general, or specifically mobile home parks. So I wanted to give this a quick session. Now we're really going to dive into the Q&A and let Chris be able to come onto camera here as well and answer any questions between mobile home park space or just investing in general, passive investing with us. And Chris, just heads up to you.
Whoa. Heads up. What's happening?
Heads up to you. That most of the people have invested, but never invested in mobile home parks. And
oh, great.
Most of them have never passively invested either. So, you know, let's get on some of the Q&A for anyone that has questions in the space. So we have a question from Roman. As a general partner, how do you underwrite mobile home parks? Hey, Chris, I can talk about this some. Feel free to add on a little bit.
Yeah. You go first, and then I'll make sure and add the color commentary.
Yeah. And you know, being a opportunistic private equity firm, what I mean by that is, you know, we don't specifically focus on one asset class on like multifamily, but we do borrow our knowledge in multifamily, which you can also think about single family if you have experience with that, to underwrite. So essentially it's expenses, income, mortgages, and the hold, and the likelihood of those things happening are based on projections. So rent, similarly, look at comps not just to mobile home parks, but also to what's happening in the market in terms of single family and also 2-bedroom apartments as well. In terms of expense ratios, you know, we work with partners who already have experiences in that space, so they know roughly what's the percentages or what's the exact line items that they'll pay for, because they already have experiences in that space. And in terms of mortgages, this is where you develop great relationships with your lenders. And the rest is really very similar to the other asset classes. I'm kind of dumbing it down a little bit, but
Well,
it's right cap rate, market volatilities, and understanding where the cap rate is now in terms of volatility, how much you're likely to sell and how much you're likely to sell in the future. So you get a combination of the cash flow and appreciation for your investment. Chris, feel free to add on.
Yeah, and so to Misi's point, right? I mean, the underwriting has a lot of similarities to other residential asset classes, multifamily. Where it does differ is it does differ in the whole concept between the lot and the lot rent, and then the home and the home rent, right? Because that is where the complexity lies when it comes to mobile home parks. Because what the bank looks at is the bank looks at how much we're getting for lot rent. The lot is how much it costs to rent a piece of land that is prepared for a mobile home to sit on it and for all the services to be provided, right? So the electricity, the sewer, the water, gas, if that is your thing. And so the lot rent and the home rent, it's important to understand that, because we purchase a lot of park-owned homes that we can then control those upon takeover. So to Misi's earlier point, we want to make sure that any tenant that's not following the laws, that aren't following our rules, we have the ability to put them on a not to renew. But then managing the home rent and getting the homes in a condition where we can sell them is, again, that's a nuance in there that you'll find with the underwriting is a little bit different, but all of the other stuff that Misi articulated is very similar. So I just wanted to tease that out.
Yes, great point. And another question is from Anthony about, is the investment structure of a fund or investment in a specific named park? So it's going to be in a fund, and one of the main reasons, and I can talk about why we like that structure, and Chris, feel free to do the same. We like the structure mostly because of diversification. In times of uncertainty, we don't like to put our funds in just one asset, because we're actually doing that with other asset classes as well, in multifamily and also in short-term rentals. I don't want all my investors to be worried because certain things happen to that particular region or that particular town and things are just not going well. We want it to be diversified geographically, and the best way to do that and acquiring assets is to put in the fund. Chris, back to you.
Yeah, no, 100%. I mean, funds are great, diversifying risk, so you can place dollars at work and, you get more assets against it. I did want to make sure that you're aware, Misi, that we are getting a couple questions coming in the chat.
Yeah, I saw it.
Yeah. So I'll field this one. Are you seeing more popularity of RV parks versus mobile home, tiny homes? I think that's two different asset classes as well. So I think we're seeing mobile home parks perform very, very well just because the tenants in many situations do not have to bring an RV or something else there. I'd say that it's also, again, the difference operationally between long-term rental and short-term rental in a mobile home park. When a home lands, it's 95% there for the life of that particular house. So it's not transitory where an RV park is. And so I think both of those things are, while you could say they're correlated, they're also different.
Yeah, and that I can add to that as well, because I've been looking at both asset classes. Being the RV parks are more short term, there are strategies to run more of a mid-term, and also sometimes have certain percentages of it more long term as well. But again, if they're more short term, it's not really affordable housing for most part, because their rates tend to be higher. What we're really focusing on is affordable housing for people who need those housing. We believe there's a strong need to it, regardless of the economy. And that's where we want to help our residents and help our investors. Next question here is, how do you handle Section A or B requirements, add difficulties of obtaining loans for mobile home parks?
So yeah, so we are not purchasing any parks that do have Section 8 I'm not sure what the acronym BMR is, but we're essentially running parks that do not have that, because that understanding Section 8 and managing that's a whole other skill set, and that's not what we're investing in.
Definitely.
And then the other second part was the difficulty obtaining loans for mobile home parks. And I think Misi answered it well, but just to add a little color. So we're finding financing of these parks in two ways: below market rate, subsidized. Yeah. So that's not something that we are subscribing to. And so what I was going to say is so we finance in two different ways. We find seller-owned financing. A lot of these parks, as Misi was stating, are owned by mom and pop operators, right? And so that means they run it as a cash business. Important to understand, because they may collect 10, deposit 8, right? So they're running it so that they can get that number, but they may be shielding some of their income from the IRS. And because of that, and then also because of the fact that they don't want to actually move into the market, we're finding a lot of opportunity for seller-owned financing. So one of the assets that we're acquiring will be financed by the seller, and they're very happy to do so. We can negotiate some great terms, etc. And then the other part is then more regional banks and banks that understand mobile home parks. So when we're buying value add, it's very important that we have deep partnerships. And so we do have it with I'd say a specialized bank in mobile home parks. And so they help us get the right financing that we need.
Definitely. Next question is around the tax benefits in terms of cost segregation, 100% bonus depreciation, or any other benefits pertaining to mobile home parks.
I wanted to go back up. Roman had one that we can answer real quickly. Yeah, I want to make sure we're going in order. Yeah, Roman, we're taking care of you tonight. Insurance is going to be lower, right? Because the replacement cost of a mobile home park is significantly lower. So you'll find that tax is much lower, insurance much lower on mobile home parks.
Yeah, typically around 30% in a 30 to 40% expense ratio. Sometimes can even be lower if they operate well.
So we do get benefits from tax depreciation, from cost segregation. And we do also get bonus depreciation. It's not going to be as significant as you're seeing in high value add multifamily, but it is significant. And again, lawyers would want us to say that past performance is not indicative of future results. So if any lawyers are listening, yay. But we generally have historically seen in year one, 60 to 70% of invested dollars coming back in depreciation. And then we've also seen it very high in the first 5 years. So we see significant, because not only do we get the cost segregation, but generally as capital improvements roll out, as we're doing paving, any type of upgrades, that will continue to roll out.
Awesome. Next question is about how we are sourcing mobile home parks. Is that for investors? Because it is a different market compared to multifamily.
Yeah. So yes, we do a lot of acquisitions. In fact, we call our partner Bo, who does a lot of the acquisitions, as he closes at the Waffle House. So yes, we get these from a lot of individual investors. So as Misi was stating earlier, right? It's very fragmented. We go into communities and we create meetups. We meet with the individual owners. We have conversations with them, but we've never been in a competitive offer for a mobile home park. And I'd say 50% of them did not have a broker involved.
Yeah, makes sense. The next question is about what is the typical lot lease term for mobile home parks, especially in Northwest Arkansas market, which is where I live, where land is a hot commodity. I think all of the markets we're going into, land is a pretty hot commodity. But so I think you can answer on that.
Well, yeah. So lot lease. So this is again where you get into the park-owned home versus tenant-owned home scenarios, right? So when we take over a park, we have park-owned homes that where we're getting paid home rent and lot rent. It's important that we split it out and differentiate it because the bank just wants to see the lot rent. And so those terms are generally going to be the parks we take over 30 days. Then what we look to do is as we rehab the homes, we want to then build out a 5-year rent to own program. We'll rehab the home, we clean up the park, make sure that it's safe, everything looks nice. And then on that rent to own program, again, that's 5-year term, but then we're making sure that we have out clauses if the new owners are not paying. But generally speaking, you'll find if they have a home there and they're leasing it, they're going to sign 1 year, 2 year again, and that's the relationship. The average is going to be for a tenant-owned home 1 year, park-owned home 30 days.
Good. Next question is about how we're stress testing this investment against like natural disasters or even human-made issues or problems.
So how do we stress test it? So a couple things is, like we do most things is we have sensitivity analysis. So we really try and understand, okay, if we're, had some type of a issue around, let's say, it's interesting. We just went through a pandemic. So we definitely can see, mobile home parks perform very well during 2020. Payment was, collections was much higher than multifamily in the 90th percentile. And that has to do with the fact that they talk about economic compression, right? If you're getting downward pressure in the market, Class A multifamily moves to Class B, to Class C, and then into mobile home parks. And many people realize that mobile home parks are the last stop on the bus before, you may be homeless or you may be looking for a lot of different other types of housing that are maybe harder to get into. So people are inclined to pay, people are inclined to stay. Natural disasters, right? So we just purchased a park in Gulfport, Mississippi. So a couple things, having been through Katrina, we were able to have very, clarity as to where the flood zones are, number one. Number two is we get business continuity insurance so that if something happens to the park, we're able to replace the net operating income for a year. And what we've seen historically is that this type of housing can be replaced very quickly. In fact, during Katrina, they were able to stand up these smaller parks, smaller types of homes called Katrina homes that were roughly around 40 square feet. They were able to fit in a pad. They got, clearance by FEMA very quickly to stand up. So we believe that compared to, again, asset classes where there's a much higher replacement cost with appropriate insurance, business continuity, and also replacement insurance for any type of the homes, we would be well positioned to get back up and running more than other types of asset classes.
Yep, good answer. Okay, question that just came up here is what any reasons that you wouldn't invest in mobile home parks?
I don't know. The reason that I wouldn't invest, so there's a few reasons. Like if I looked at a mobile home opportunity, right? Some mobile home parks have, are completely removed as far as they have. Some of them have what's called I can't remember the name of it, but it's almost like a septic marsh. Like there's certain mobile home parks that have this type of septic system that's very old and is very hard to maintain. So that's it. I also think if the mobile home park is just, we're taking like I'd say 2-star parks and trying to get them to a 3-star, 4-star. But sometimes if the park is too far gone, or on the edge of town, that's also a reason that I wouldn't do it. And then also, if you don't have an experienced operator, out of state operator, I think that's something that's a question mark, right? You need to make sure that you have members of the team that are in and around the parks all the time. These things take care and feeding. Those are some reasons why.
Makes sense. Yeah, I think the septic is a big thing because that affects like things like water qualities and many different things that could potentially put the owners or the investors in a compliance issue if they don't handle it well. So it's good to know that, partners we're working with has experience in handling all of those. Next question is, when you buy in a renovate the existing park, what happens to existing tenants, some of whom may not be able to afford the increased rent?
Yeah, if somebody is wanting to pay, if somebody is wanting to participate and be in the park and they're a good and healthy tenant, then there's a lot of social services that we can get them in touch with, especially in our hub of Fayetteville. We have a lot of opportunities there to connect them with people that can help them out. Some of those may be government, some of those may be some different churches and other things. But if somebody says, I want to stay in your park, I can't afford this increase, but I want to continue to participate and pay and do things, then we can find them help.
Yep, exactly. We're here in the people business at the end of the day, so we want to work with the right people. Next question is about what's our investment criteria, cap rate, cash on cash, and debt coverage ratio.
Well, I'm sorry. I was trying to find the other set of questions. Oh, that came up through that one.
Yeah. About what's our investment criteria, cap rate, cash on cash, and debt coverage ratio.
Yeah. So I'd say that our criteria is, you look at the price per lot. Right now, we're trying to buy anything that's $32,000 per lot or less. That's one of our main buying criterias. The reason being is because we're seeing, again, the market rent right now in Fayetteville is somewhere between $450 and $475 lot rent. So that then gets us to where we need to be. But our target, you'll find that we set our preferred returns below our target returns, but our target returns, projected returns, is what we're focused on, which is 10% cash on cash. That's what our main focus is, because this is why we're here, is we're in a firm belief that we need strong cash on cash returns to be financially independent. And so that's what we want to find, deals that cash flow. Cap rate is generally going to be, we find opportunities that are 9 to 10 cap.
Yeah.
And debt service coverage ratio. So we do 70% loan to value. So you'll find that, generally speaking, our debt service coverage ratio is going to be around 2.2.
Yeah. Another thing is we look for opportunities that's already cash flowing, and that's very important to us because our investors want to provide them that additional source of income as early as possible. In the times of crisis, nothing's better than cash on hand. So
yes.
Let's see if there's any other questions coming in. I'll give it 1 second while I launch another poll here.
Oh.
Feedback from the attendees. If you have any other questions, feel free to put it in the chat here. So as we're coming to the end of the webinar, we want to thank you so much for joining us here. Again, I at Life Mission Capital, Missy here, will be launching this offering in October. We're sorting out some of the legal documents here. So if you're interested, please book a passive investing call with me if we have not talked. If we have, just let me know what you're interested in, and we'll share the specific details of the investment during the launch. So yeah, thank you so much. I'm going to leave the poll here a little bit longer for those that haven't answered. And otherwise, I didn't see any other questions coming in. Really appreciate you being here, and hope to see you soon. Thank you, guys.